Good evening and welcome to the Kriependruck Stock Market Show. Today's Thursday, the 11th of May 2023, and here are today's topics. Sweden's real estate sector worried about refinancing issues. The FDIC having to recover its losses associated with rescuing Silicon Valley Bank and Signature Bank. Jamie Dimon commenting on the banking crisis. And of course, we will also summarize today's trading day. Sit back, relax, and enjoy today's show. All right, let us jump right into the first topic, which is very interesting: Sweden's real estate sector. Now, Sweden's real estate sector has a lot of problems right now because of its dependence on short-term debt that actually matures this year. Now, what we have seen so far in general in the real estate industry, high interest rates putting downward pressure on real estate property prices. And at the same time, of course, these tighter bank lending standards, they make these real estate companies more vulnerable. Now, both of these, in addition to Sweden's reliance on short-term debt, has caused hedge funds to actually put short positions on these Swedish real estate companies. Now, SBB, a very, very large Swedish real estate company, one of the biggest in the industry, has been downgraded by the S&P credit rating agency because SBB did in fact announce, or the danger exists that they need to refinance their short-term debt, which matures this year. Now, what has happened during the era of easy money, Federal Reserve and central banks in general, keeping interest rates near 0%, and in addition to that, obviously doing quantitative easing, has caused real estate companies to load up on debt due to high property prices and low interest rates. However, what is happening now, interest rates have essentially gone from 0% to 5%. This can be especially seen in the US, the Federal Reserve. We're now at a range between 5 and 5.25%. Now, borrowing has become much more expensive due to those rising interest rates. And this means that companies who have a lot of short-term debt that matures this year, debt that used to be very cheap due to low interest rates, they now have to refinance that debt. And that, of course, also puts banks in a peculiar situation. Banks that are already suffering under an increasing bigger outflow in deposits. So real estate companies have to refinance their short-term debt, and that, of course, puts a lot of pressure on these companies, and especially Sweden's real estate sector, which is dependent on the short-term debt, has now been, hedge funds have now put a lot of short positions on those Swedish real estate companies. Now, but this is not an issue that is isolated to Sweden, obviously. McMorrow from Capital Economics said today, the situation in Scandinavia in general is the situation in Europe is not drastically worse than in Scandinavia or especially Sweden. We will also see these problems in other countries because generally interest rates rising from such a low level to such a restricted level in such a short amount of time obviously will cause some companies to suffer under their short-term debt and cause them to refinance it, right? And that will, of course, put a lot of downward pressure on the shares of these companies, as we are seeing with the hedge funds in Sweden right now. Very, very interesting topic. The Financial Times reported about this today, and this is definitely something that we will keep an eye on. Okay, let us now talk about the Federal Deposit Insurance Corporation, in short FDIC. Now, the FDIC had to pay a lot of money in order to rescue banks such as Silicon Valley Bank, First Republic Bank, Signature Bank. And this has drained the money in the deposit insurance fund. So the deposit insurance fund needs to be replenished with money. Now, the FDIC today has announced that big banks will have to pay $16 billion in fees over the next 2 years in order for the FDIC to replenish this deposit insurance funds. The deposit insurance fund. Now, large lenders with assets of at least $50 billion will pay more than 95% of the fees required to restore this fund. and banks with assets below $5 billion would be spared. This is a very, very important step. The FDIC has to eventually consider how to replenish their deposit insurance fund. And who knows, maybe more bank failures are to come, which will require the FDIC to step in again. Now, the fact that the FDIC has actually, now, like I said, the FDIC has a deposit insurance limit of $250,000, but in the rescue of banks such as Silicon Valley Bank and First Republic Bank, the FDIC has actually also compensated for deposits above the insurance limit. And obviously, that has drained a lot of funds out of the DIF. So this is a very, very important step. I'm very happy that the FDIC took the necessary steps today to announce this. Of course, it could be argued maybe this is not the best way to do it, but the big banks obviously are also the ones that profit the most under acquiring banks such as Silicon Valley Bank. JP Morgan obviously acquired First Republic Bank, and JP Morgan has profited from that a lot. So in general, it is good that regional banks, or in general banks with assets below $5 billion, are not really included in this replenishment of the fees, but mostly only big banks with assets of at least $50 billion. Jamie Dimon, the CEO of JP Morgan, had an interview today on Bloomberg, and he said some very interesting things about the current banking crisis. Now, he has not been very clear. He did not mention any clear things that the FDIC or the Fed could do now in order to solve the problem, but he did mention that it is time for regulators to put an end to this banking turmoil that we are seeing. He did not, in fact, call it a banking crisis, which is also very interesting. To quote Jamie Dimon, he said, whatever the Fed, FDIC, OCC, whatever they do, they have to make the situation better. Whatever they can do, they should do to bring some confidence back to the banking system and to avoid any further collateral damage. Now, regarding the general situation of regional banks, Jamie Dimon said in today's interview that regulators need to get a better handle on the regional banks. And because in general, and regarding short selling, he also made some very, very interesting comments. If you look back at the previous week, we have seen shares of Pacific West and Western Alliance Bank come under significant pressure. Now, you might ask yourself, why was that the case? Because both banks, they have a large amount of insured deposits, way more than the other banks that collapsed, for example, Silicon Valley Bank. So they have a higher amount of insured deposits. Pacific West and Western Alliance, both banks have made it clear that they have enough liquidity to cover even the uninsured deposits. And in addition to that, they said they have not seen a significant increase in deposit outflows since JP Morgan acquired First Republic Bank. So you need to ask yourself, why have the shares come under such significant pressure? Even though those banks, they're not even, their asset side of the balance sheet is not even so dependent on securities. Now, one of the reasons is short selling, right? These banks have come under such significant pressure due to short selling. So Jamie Dimon said in today's interview, which does make a lot of sense, he said that the Exchange Commission should look at short selling for unscrupulous tactics, right? And what this might do, it might restore some confidence in the banking sector if the Exchange Commission, or actually let me phrase it differently. Well, confidence is what needs to be restored in the banking system, especially within regional banks. But if the Exchange Commission would look at these short selling tactics, right, this short selling might cause a bigger problem than all of us expect, because if the general people see that that shares of a bank are 50% down in one day due to in part short selling, people are going to become worried and they might pull out their deposits. So markets in this case might be the very root of the problem. They might cause a run on deposits in such a highly connected world, right? In a world of social media, in a world where you can pull your deposits out instantly, right? So the short selling, if shares become under such significant pressure, this might actually cause a deposit flight. So I think it would be smart for the Exchange Commission to, in fact, look at this. So I definitely agree with Jamie Dimon in this case. In general, what needs to happen is confidence needs to be restored in the regional banking sector. Another thing that Jamie Dimon made clear in this interview, the general banking industry, not only the big banks, also the regional banks, they are in a pretty healthy state. Think about it. In fact, banks had the most profitable quarter this year on record. Two things have contributed to this record high profit. One, obviously, banks do profit to some extent under rising interest rates, right? Putting also to some extent upward pressure on net interest income. But the second point is banks such as Flagstar, who acquired Signature Bank, or banks such as also First Citizens Bank, who acquired Silicon Valley Bank, right? These banks, their profits increase by an incredible amount when they acquire these collapsed banks, especially obviously because the FDIC supports that rescue a lot. So they made a loss sharing agreement, for example, with First Citizens and Flagstar with those two banks. So the fact that we are seeing some banks acquire banks that are under significant pressure or that have collapsed, this of course obviously boosts profits. So in general, the banking industry does seem to be in a good state, but some confidence needs to be restored in order to avoid scenarios such as we have seen with, for example, Pacific West and Western Alliance. So if confidence is restored, for example, by the FDIC really making it clear that the deposits even above the 250,000 deposit insurance limit are indeed insured, those are all things that could restore confidence. And that is what Jamie Dimon means when he says that whatever the Fed, FDIC, OCC, whatever they do, they should do whatever they can in order to improve the situation in the banking sector. Okay, let us now get to the summary of today's trading day. Now, what was moving markets were basically two data points that were released today. On the one hand, jobless claims, on the other hand, the producer price index. Now, jobless claims came in at 264,000 versus an estimate of 245,000. This is the highest level of jobless claims in 2 years. At the same time, the producer price index came in at plus 0.2% in April versus a 0.3% estimate. Now, what does this tell us? Jobless claims coming in much higher than expected. The fact that it reached the highest level since 2 years shows that the labor market is indeed starting to cool down. Producer price index also coming lower than expected obviously means that inflation also continues to come down. However, like I said in yesterday's video, you must look at the totality of the data. The service sector remains incredibly resilient. The labor market remains incredibly resilient. And I do not believe that inflation can, in fact, fall back to the 2% target without seeing a deterioration in or an increase in the unemployment rate, for example, and clear weakening in the service sector. So the Federal Reserve ultimately has to stay hawkish for longer. And I don't really believe that this changes much. What it does do is it shows that we are indeed moving in the right direction. But obviously, regarding the general inflation level, the fear is that inflation will simply stagnate at some level, because I simply cannot believe that it can fall down to 2% with such a resilient consumer and with such a resilient labor market. Now, how did markets react to this? Basically, yields up, the other way around. Yields down, stocks down, 10-year treasury yield minus 5 basis points fell to 3.39%. It makes sense that people are buying bonds. This data is showing an indication of a weakening economy. At the same time, inflation coming down. The markets believe the Federal Reserve will start cutting rates sooner, which causes the yields on treasuries to fall. Now, the S&P 500 at the current time, it is 952 in Europe. The S&P 500 down by 0.22%, fell to 4,128.09. The Dow Jones Industrial Average negative 0.76% at 33,276.06. Now, the NASDAQ 100, it is up today. It makes sense that it is up. The fact that yields are down, people are expecting a less hawkish Federal Reserve based on this data is, of course, boosting some risk sentiment in the stock market. So the NASDAQ 100 slightly up by around 0.3%, increased to 13,388.79. Now, that is a very quick summary of today's trading day, just to give you some more general information about some other indices. West Texas Intermediate crude fell 2.3% today to $70.9 a barrel, and gold futures fell 0.9% to $2,019.50 an ounce. All right, and that is it for today's stock market coverage. This is basically what I'm doing now. This is basically a completely new concept. I do these types of Book stock market shows now, in which I talk about the most important topics of today's trading day, and I'll also, of course, summarize the trading day for you. Now, I hope you will enjoy this new concept. New episodes will be released every weekday. I am an economics student, very passionate about these topics. I would really like it if you could give me some feedback, and I hope I will see you back tomorrow.